Hello, and thank you for joining us for this edition of CBH Talks on Target's Canadian Odyssey, Untold Stories of Expansion and Collapse. My name is Tabitha Fritz. I'm on the board of the Canadian Business History Association, and the CBH Talks are a monthly talk that we hold with different experts in business history, Canadian business history, bringing you some interesting topics that we think you will enjoy hearing about. So we have two panelists today. Our first panelist is Steve Delios, whose career spans more than 20 years with many of the world's largest organizations. His experiences have crossed industries and functions. He's held leadership roles in commercial strategy, marketing, and operations with Fortune 100 companies, including P&G, Kraft Heinz, Walmart, Target, and Grainger. Over his career, Steve has had the opportunity to lead in a breadth of business environments, from startups to growth acceleration and to turnarounds, which have all contributed to his leadership approach today. His signature strengths are strategy, decision, execution, and personal development for business improvement. And our other panelist, our moderator today, is Steve Penfold. Steve Penfold is a professor of history at University of Toronto. He specializes in the social, cultural, and political history of 20th century Canada. He's just finishing a general history of Canadian shopping, from fur trade to free trade, aimed at undergrad students. His current research is in energy history, including an examination of British Columbia Premier Duff Petullo's heated dispute with American oil companies during the 1930s. Thank you so much for joining us. Steve Penfold, let's start with you.
Okay, so I think we've got an interesting method here where, as an historian, I'm going to sort of trace out some broad developments, and then the other Steve, it's the two Steve process, the other Steve is going to come in to talk about his kind of experiences more specifically in that context. So I think the first point I think we kind of want to make is that when we talk about the coming of Target to Canada, we're talking about an era when the consumer economy was experiencing a lot of disruption. In fact, I often, when I teach on this, call it the age of disruption. Up to the 1970s, the consumer economy was going through 3 decades of growth and stability, where more and more people, more and more Canadians were being added to the consumer economy. Even working people were getting a taste of a burgeoning affluent economy. So everyone seemed to be doing relatively well. Not everyone, but most Canadians were doing better. And people talked about this growing middle market of consumers who were really characterized by a similar set of buying practices. But then in the 1970s, we see the development of a much more unstable consumer culture. There was an energy crisis, inflation on and off, recessions became longer, and boom times became shorter. There was a broad trend towards greater inequality. And one of the ways this was experienced in retail was in a much more fragmented retail economy, that if the kind of model of 1950s or 60s consumerism was the Eaton's or the Hudson's Bay company at the mall, by the 1970s, this kind of middle market that department stores could target was kind of fragmenting into different levels and different kinds of consumers. I always like to use the example of when the Hudson's Bay Company buys Zellers in 1978. They also bought Simpsons at the same time, and they thought that they essentially very explicitly positioned this as Simpsons would allow them to see the upper end of the market, the Bay would be their middle market, and Zellers would glimpse the bottom of the market. And this was a pretty successful strategy overall for the Bay. Zellers in particular did very well. This is an age in which discounts do very well. They exist in the 1960s, but they really come into their own in the 70s and 80s as there's just this greater pool of low-income consumers. And so, the number of Zellers doubles between 1978 and the early 1990s. So this is a really disrupted time. I literally once entered the word disruption into like one of those newspaper databases, and you can actually chart just people use the word disruption a lot more in the 70s and 80s and 90s than they did in the 50s and 60s. It just is a word that's just everywhere in this period. So Zellers does very well and has about 300 stores, like double the number they had in 1978 by 1993. They're doing very well. But then, of course, as I always like to put it, the Death Star, sails into the Alderaan system, essentially. That the big player, Walmart, comes in 1994, and by 1997, the late 90s, Zellers is losing money. And they actually, again, they respond to this by doing what a lot of people do. What kind of market niche can we find? Instead of thinking in those broad kind of terms that the middle market players used to, they try to position themselves in a much more crowded kind of market. One of the ideas that's floated was to kind of become the Target of the North, the kind of just like slightly above Walmart in a discount kind of approach. But of course, Walmart is very well run, very well funded. They grow across the 90s and the 2000s, succeeding in this much more fragmented kind of market, partly by attracting lots of different kinds of consumers, but really targeting that lower kind of end, what Zellers used to call mom, the kind of mother shopping for the family, looking for low price, high value kinds of products. So part of Zeller's problem and the discount problem was both this broader economic thing, but also Zellers couldn't, like most, couldn't compete with kind of Walmart. So Target is coming into an economy, a consumer economy, that is much less stable than the old middle market players like the classic department stores of the 1950s and 60s, a much more crowded and less stable kind of area. And of course, Zellers really captures that market because it did very well after the Bay bought it. But by the time Target is contemplating coming, Zellers is in a lot more trouble. So maybe I'll just pass it over to Steve to come in on that point.
Yeah, no, thank you for that. Good afternoon, everybody. And I think disruption is a really, really strong word and an accurate word to describe the time. You fast forward to around 2009, and you have two different, you have multiple forces coming to place in disruption. First, on the United States side, you have one of the largest financial collapses. And Target at the time is only operating in one marketplace. So you're significantly overexposed to deliver shareholder returns when you're operating in one marketplace in which your local economy is almost operating as close as it could be to the Great Depression. And then you go on the north side of the border, and you have the disruption of what Walmart had caused and the impacts of it to a number of organizations, in particular HBC. So, as I talk about the Target journey, I bucket it into three different, call it phases. The first phase is the deal itself and what really went wrong behind the scenes. So to build on to Steve's point, when you look at the deal, it's good to remind ourselves what actually happened. HBC, for all the reasons that Steve had mentioned, had ended up selling to an individual named Richard Baker, an investor out of the Carolinas. And he had acquired the entire assets for approximately around $800 million. But in that deal, he acquired the Bay brand, he acquired the Zellers brand, he acquired the distribution centers, he acquired the head office. And there's a lot of information on who Richard Baker is. I really encourage people to read up. But Richard Baker's not really in the retail business, he's in the real estate business. And shortly after acquiring the organization, he puts for sale the Zellers brand. And really understanding what the deal was is now, the most important piece of this. If you think about in the US, they're struggling to stay afloat in terms of a lot of these organizations. There's pressures to go international across many geographies and many industries. The costs of the unit economics are just not what they used to be. Walmart had a big play on that. And then you have the pressures to go international. And so, to skip a little bit of the details, what Target actually acquired from Richard Baker and the HBC organization for $1.7 billion was the leasehold access rights to approximately around 125 locations. And that's really, really important for people to understand, because if you think about it, just a few short years earlier, Richard Baker had acquired the entire organization for $800 million. And now he just sold leases, and not the actual lease themselves, the access to the leases for $1.7 billion to Target. There's a whole other conversation we could have is in terms of how much did they overpay and why they overpaid. But right off the bat, what you see is the pressures or the disruption that Steve's talked about to have to grow, have to expand, have to go, really put them into not a good spot to begin with. They're already behind the 8 ball acquiring it. So why is the lease access rights important? They already went committed to addresses before they could even negotiate with the landlords how these deals were going to work. So right off the bat, they are negotiating from a place of less power because of the demands or the disruption in terms of why it was so important to go international. And then in the deal itself, it's important to also include what was not included. So, for example, they thought that they could lease out distribution centers into Canada as part of their, because they did not acquire any of that from the HBC deal. Unfortunately, those types of locations didn't exist. And then, unbudgeted building of 3 distribution centers that were never part of the plan had to occur. And so, examples such as that place the business on such a cost overrun behind the 8 ball that, unlike the Walmart deal, when Walmart first acquired Woolco, in the Walmart deal, they actually never shuttered a store. That the unit economics and the cost of entry was much more favorable for all the reasons that Steve said, that they had the ability of renovating stores at a very, casual pace to keep the revenues coming in at a cost that made much more reasonable sense, which allowed them to have a position of power over time. Unfortunately, from Target, they were negotiating from a position of not being in strength, combined with the overrun positioning of the cost of entry, already started this journey from before it even, day one, from being behind the 8 ball. And I'll talk later on about how that impacted phases 2 and 3.
Okay. Another thing, kind of issue we wanted to talk a bit about was the kind of question of expansion to Canada. And this is obviously one of great interest to historians of retail and consumer economies generally, in the sense that Canada's consumer economy has always been an extension in many ways of the American consumer economy, both in terms of American companies expanding to Canada, but also Canadian companies essentially modeling themselves on Americans. And one of the tensions in that expansion when Americans come to Canada has always been, how much do we adapt to the Canadian market versus how much do we stick to our operational marketing principles that we had in the United States, which seem to work there. It's a question partly of how different the Canadian consumer economy is. And, there's been successes and failures on both sides. Like, McDonald's came in and operationally very similar, but had some slight differences, like they had vinegar for French fries or whatever. Like sometimes they're just these small little things where other companies have sort of misunderstood how much they have to change. And so I'm just wondering if maybe you could come in on this question around that tension of coming to Canada. How much do you have to adapt versus how much do you stay the same?
Yeah, I think to me, this is probably, outside of cost, this is probably the most important piece. And really, I love your comment about misunderstood. To me, the real education in all this is, what does it mean when you go international? What do consumers want? What do customers expect? Do you have the pedigree? I've been fortunate enough to work for a number of world's largest companies, who operate in many countries. And you see a similar pattern there. And what I would say is, and I'll give a couple of examples in a second, Target's inexperience, so Canada being their first international expansion ever, they really didn't understand what it meant to go international. What they thought the customer wanted was the exact same Target experience that you got when you're going for a vacation for a week in Florida. But that's not what international really talks about. If you look at some of the world's largest organizations, McDonald's, Walmart, just to name a few, Disney, what international expansion really means is, hey, I want to experience the unique properties that make you you, I'm going to see Ronald McDonald in every McDonald's around the world. I'm going to see Mickey Mouse, in Disney. I'm going to get a Big Mac. But I want you to deliver it to me in a way that matters to me in my local market. So think global, act local. In the case of Canada and Target, a little bit of their arrogance and a little bit of a lack of experience, that wasn't what held true. And some of the examples that I would share, what typically doesn't happen in international expansion is, first, it all starts with the management team. Besides one individual, the entire management team were from the US, all born and raised in the Target world. So no external hires, no leaders from the Canadian market, no international. Quite frankly, nobody with any experience on operating international, marketplace. What they thought was they made a bigger bet of having the expertise of people with 20, 30 years of experience of what does it mean to be Target was more important than what does it mean to be Target in Canada. And because the bet that they made was Canadians wanted the Florida experience. That's not what Canadians wanted. Canadians wanted the properties of what makes Target Target. I want to find cheap chic. I want to see clean floors. I want to be able to get my Starbucks. I want to see that cool t-shirt for $14. But they wanted it uniquely delivered to them in the Canadian way. I want to see my Thursday flyers. I want to see things on sale. I want to see hot front page ads. In Canada, we're much more reliant on promotions for a number of reasons than we are in the United States. In the United States, between Walmart and Target, EDLP is a much bigger part of their strategy just because of the way the marketplace works. That's not true in Canada. But when you're led by a management team that's very young by DNA, just by straight age, and who have never worked anywhere else, that had no experience on running an international team before, and quite frankly, never had international experience in completely at all, it caused a lot of friction. I remember in the early days, we would argue a lot because we would say, hey, we need flyers at our front doors. That's what Canadians wanted. And I remember being in management meetings where certain individuals would say, as long as we're here, you will never find a flyer in any Target in Canada. Well, go walk into a Shoppers Drug Mart, go walk into a Walmart, go walk into Loblaws. As I say to people, if you go to Walmart in Asia, you will never see live fish for the most part in the United States. You will never see live fish in Bentonville. But when you go to Asia, you're going to see live fish because that's what that market, you think global and you act local. And so I'll pass it back over to you, Steve. That, are just a couple of examples. The one example I always share with people is in Canada, we are over-indexed at Canadians love orange juice, with our breakfast. So if you walk into a grocery store, you see a lot of orange juice. If you walk in the United States, drinking orange juice is not that common. And I remember infighting because it was hard for people from Minnesota to understand why we want to shelf so much orange juice, because that's not the way, as the sentence used to say, that's not the way we do it at Target. Well, it's not about what Target wants. It's more about what your customers expect. Mm-hmm. And so getting mom, we used to use the Target, that name too, Steve, all the time. Getting mom and how she buys when she's in 1 week in Florida is not the same as how mom shops in Canada for her weekly routines. Mm-hmm. And the marketplaces between Canada and the United States are different enough. We have a higher percentage of dual income earners in Canada. We have a higher percentage of moms who don't stay at home. We have a higher percentage of, cost of living in Canada is higher. We have a higher percentage of reliance on sales. We have actually, we drive further to our stores. So this whole, hey, how do I bring you into my one-stop shop is not about a geography. It's about a way of life for Canadians. And it was very hard for Target to understand. I need to deliver you the bullseye. I need you to deliver you the clean stores, and I need to deliver it in a certain way, but I got to deliver it in a way that's local and meaningful to you. So the lack of experience was a big deal.
Can I just ask a quick question before I move on to the next thing? Do you think the Target people in the US thought of this as international expansion at all? Or did they sort of see this as like Canada's so similar. This is almost like regional expansion. It's like going to the south or something. Is it like, do they conceive it that way, do you think?
Yeah, great question. And I remember being in a lot of meetings about this. So there was a lot, remember back in 2009, there were a lot of, I can't say all information, but there was a lot of pressure to go international. One of the advantages to Canada, besides location, remember in the United States, Target is based in Minneapolis. So it's less than an hour flight across the border. The proximity between the two countries and the shared border, what's it saying? Over 80% of Canadians lived, within 100 miles of the US border. Provided them the intel that they believe that entering into Canada was a closer experience because of all the usual factors, both being North American, than maybe other countries around the world. And so, sure, we say we share a lot of thoughts and beliefs about things. However, they still underplayed. A lot of their research in the early days were on bordering Canadian cities, but it doesn't reflect Mom in Fergus, Ontario. It doesn't reflect Mom, in Waterdown or parts of the Maritimes. So though they did believe, and our data suggests there's a lot of similarities, I don't think they did a good enough job understanding how uniquely different the geographies are, both in terms of the cost of business. As I tell people, the California market alone is bigger than Canada. So when you talk to an individual in Minnesota, besides Hawaii, and you say, hey, to get a T-shirt to parts of the Maritimes, you got to put something on a truck, then on a train, then on a boat, and back onto a truck again. It's hard for people to understand what that means. And so their lack of knowledge of how Canada works really, really played a part to it. Yeah, yes.
So I think our third bucket of kind of themes is the sort of questions around operations. And obviously this is an area, from an historical point of view, consumer corporations since, the late 19th century have been obsessed with operations, distribution, these kinds of questions. The old mail order companies like Eaton's had a huge mail order wing, that by the 20s was larger in terms of revenues than most of its other competitor department stores, let alone their mail order operations. These were like enormous. And, this was like Amazon scale percentages of the retail market. Like this was the Eaton's was an enormous operation, and it's thing even by the 20s, but of course it gave up on that in the 70s. So the question of operations and distribution is a long-standing one in retail history, not new, but of course taken to new heights, as you know, by Walmart, and the absolute focus on logistics, essentially, like moving products, cross docking. Their distribution centers is the kind of core of their business, a place where nobody seems to be able to match them at all. I mean, and it's not just buying volume; it's also just the unbelievable efficiency of those processes, where it's not like no one had thought of this before. It's just that Walmart was able to do it to a kind of uber degree. And so by the time it came to Canada, it was operating a machine that was just so efficient that even Zellers, which by that time was pretty efficient by Canadian standards, couldn't compete. So what place do you think those sorts of logistical operations, nitty-gritty kind of questions played?
Yeah, this is now the third phase I talk about the journey, right? So to recap, phase one, it's just a bad deal. You're behind the 8 ball. So now you got to execute brilliantly because you've overpaid to enter. Now you go into phase two. You're led by a management team and an organization who has no experience, no pedigree of going international. So you're going to make even more mistakes on top of overpaying. Now you go into phase three, the day-to-day operations. And Steve, you bring up a good point about, the Walmart example. Having had a leadership role at Walmart, we used to always say, you need to be ready to go international. And, their definition of readiness is, are you ready to go? Do you have the resources ready to go? Do you have a balance of, international experience? Do you understand the marketplace? It's a bigger decision than just saying, let's go, right? And so I think it's so important, before I share the challenges that Target faced, how different the Walmart experience was, when they went in. See, people forget, when Walmart first came to Canada, they continued to operate the local stores or the local network. And then they just start to rebrand it into the Walmart network, and then slowly change things over time. And so what does that mean? Number one, in the Walmart deal, they acquired all the local distribution centers. So they flipped the switches and they kept going. They knew it wasn't to Walmart standards. They will improve on that over time. On their stores. Not one store for a single day were ever closed during the renovations. They would slowly turn over their stores. And probably the biggest decision, they said, we're going to inherit all their staff and we will slowly convert over. Now, for all the, you talked about the word disruption, Steve, earlier in the chat. The economics allowed for that kind of things to happen, back in, the 1990s, right? There was no Amazon, there was no e-com, people were still shopping in malls. Unit economics are not the same now, you're going in, when Target opened up their stores. And so then you say, okay, what was the implication of their decisions on the operations itself?
Mhm.
First, but to the lack of experience, and I'll give you some examples. I have a ton of respect for Target in the US. And a lot of my peers are still there. I think the arrogance and the cockiness of we're going to do it the Target way got the better of them. All right. And I'll give you a couple of examples. If you think about the distribution centers. Well, in Target, in Walmart said, we will just take what we got and we'll get better at it. Target's answer to everything was, that's not the Target way. Everything with Target had to be, their brilliance of wanting it exactly like the US. But the US people have to remember, the first stores opened up in the 1960s, they had about a 60-year head start. They wanted Canada day one to feel like what happens in the United States after 60 years. And it doesn't work that way, especially when you want to, go into a new marketplace, especially in an industry in which at best your margins are operating around 4%. So remember, for every $1 that comes in, you already have 96 cents going out. You're keeping 4 pennies on every dollar that comes in. So when you think about what happened to our day-to-day challenges, yes, everybody understands that we had supply chain issues. Everybody understands you couldn't find your favorite shelf or out of stocks. I've seen those pictures too. But you have to understand the whys. And so the first why, distribution centers. We were forced to build our own because we didn't inherit any. And again, back to ego, we assumed that those types of properties in Canada existed. So if you think about it, not only did we go pot committed and say we're going to open it up in 2 years, at one point within that 2 years, we didn't even know where our distribution centers were going to be, let alone figuring out how you're supposed to build, train, and so on and so forth. So that by default will create operational challenges. The second one, probably the biggest decision that operationally I think, people will always look back on, is the staffing. Walmart said, whoa, it's going to be way too hard to try and rehire all these individuals. Let's just start with the people that we have and we'll build over time. Target believed that it meant a special, DNA of what it meant to be a Target associate. And in fact, they actually let go of all of the Zeller staff. You could reapply for your role. And now if you think of how daunting an international expansion, on top of everything else, we had to rehire 18,000 people. And you had less than 2 years to do it. And so when you think about what kind of operational challenge that means, you're hiring people that don't come from this industry. You've upsetted people that you probably could have done a good job. There's a whole big bet you're making when you decide to make that call. And then the third piece is, what I would call infrastructure. Most notably, some of our softwares. In the US, like any business that's very old, you have a lot of tribal knowledge, you have a lot of old infrastructure. For all the right or wrong reasons, we couldn't lift and land a lot of our processes. And the biggest one was SAP. Mm-hmm. And so Target does not use SAP in the United States at the time. We felt for all the whatever reasons, right or wrong, obviously wrong now, that we were going to launch with SAP. And for anybody that has experience with SAP, it's one of the best systems in the world, and it's one of the hardest systems in the world. But when you're launching a new organization with brand new infrastructure, with brand new employees, with no tribal knowledge, with no so on and so forth, and then you layer on top a software system that has no history, it's the perfect storm for operational challenges. And when you take that phase 3 and you back it by a management team that doesn't have any experience on how to navigate through the trials and tribulations of anything international, and then you back that behind with you kicked off the gate in cost overruns, effectively what you're suggesting is if this doesn't run perfectly, the chances of failure are higher than chances of success. And this is not, a reflection of Target. People always ask me, like, is this Target the only company that has made this mistake? No. People forget in Canada, and when Walmart entered into Woolco, they entered in with a humbleness of how we're going to convert. That humbleness resulted into aggressiveness. And a lot of people forget Walmart launched Sam's Club into Canada very similarly to how Target entered to Canada. The difference between the Walmart Sam's Club model and the Walmart stores model was the Walmart stores model acquired Woolco and did a slow transition. We're gonna, in fact, the Walmart Canada CEO, I apologize, forget his name at time, the longest running original CEO, was actually the Woolco CEO. And so, but if you compare Walmart's Sam's Club launch into Canada, which a lot of people forget was a very quick entry and exit, that fell very similar to the Target experience. Walmart deployed all their their top Sam's Club executives. They didn't understand the landscape. They brought Sam's Club into Canada the same way on how they do their models in the United States, which is where we see a Costco, just put a Sam's Club right next door. They led it with US teams. They didn't understand the Canadian consumer. They didn't understand, well, if you're a club shopper, how many Canadians actually want it? How many Canadians actually want 2 cards into their wallet? So this, what I call the arrogance, lack of experience, also goes to show you that just because you're the world's largest company doesn't mean you're guaranteed success. The humbleness of what they learned was when they launched, Sam's Club into Canada was, hey, there is a way on how you're supposed to go international, because we just tried this a different way in what we did with Sam's Club, and no different than Target. It only lasted a few years, and then they exited out of the marketplace. So there's, even in that case, I think there's a lot of lessons and learnings that people could, really take a look at to say, what is a best-in-class case study on how you go international? What are the do's and don'ts? And how do you find that balancing act between I'm looking for shareholder value, but at the same time, I got to do this in a sustainable way?
What I find interesting about what you're saying too about the issue of Canadianness and going slow is sometimes you feel, I can't think of an example right now, but I'll think of one by the end of talking. The one approach to come to Canada is hang beavers off everything, like really go. The other one is to do nothing. But what is fascinating is, as you're saying, like the differences are actually these kinds of really pedestrian things like flyers, and these are the differences. In one way, they're very symbolic of big differences in the consumer economies, but in another level, it's not symbolic. It's in these sorts of practices of how far will people drive, how many women work in the home and outside of the home, and this kind of thing. Do you think, let me ask you one more question, just because I'm fascinated. Do you think Target Canada could have succeeded given how far behind they were coming in with those real estate? Like in the end, is that in the end the kind of the fatal blow, or could they have succeeded with that real estate deal?
That's a great question. This is the one that I always get asked, the most. I think it all depends on what is your goals and what are you trying to achieve. I don't blame for what the new, people have to remember, January 2015, what was happening, right? That's the day, that's the month when Target pulled the shoe. We had one of the world's largest data breaches after, the United States just, not too long before that. Their longest serving global CEO or US CEO was let go, which is unheard of in the target world. The Canadian president was let go. We were at the time a $75 billion company in the US. And Canada was a rounding error on the top line. But we were losing $1 billion a year in profit, right? So we were taking a big chunk of their profitability. Our stocks were driven on an all-time low. Whenever I make a decision, so you ask me the easy question, Steve, I always never give a decision on one factor. You got to look at all the different factors and all the variables. And so people have to understand why was the decision made? And at the end, and you have to read between the lines of what the data says and what the news, postings are. At the end of the day, the decision to exit Canada was, what's the role of a CEO of a publicly traded company? The role of a CEO of a publicly traded company is to deliver shareholder value, shareholder returns. When the current CEO, who was an external hire at the time, Brian, he inherited a company that had all-time lows across the board. You're losing billions in a marketplace that you were never held accountable to. Some of your best US resources were being deployed into that marketplace. So I'll tell you the worst part about it, but then I'll tell you what the future risks are. You're in a state where you're rounding error in your top line and you're sucking, your profit on your bottom line. You are in such a massive cost overrun position that, I think some of their early projections, it would take something like 7 years to maybe even just break even on an operational, that hole was so big. Mm-hmm. And then you say to yourself, well, then what are the advantages of leaving? Right? And then I'll talk about it in a second, the disadvantages of leaving. The advantages of leaving is you stop the burn. We were not producing anything on the top line. You improve your profitability immediately by exiting the marketplace for the first couple of years, and that's what the bankruptcy proceedings did. You get to redeploy back your talent back into the United States. It allows you the capacity to put more strategy in, and so those are the pros of going. But then you got to say, okay, then what's the long-term impacts of going? So I think they got really fortunate because of the pandemic, right? If you look at their stock price today, obviously it's massively grown in value. A lot of that had to do with, they reinvented their stores and the experience. A lot of that had to do with almost every retailer has grown coming out of the pandemic because people's shopping behaviors have changed. So I think that's a big bet that they made that they didn't realize that they made, and they're benefiting of it. Now, what's the downfall of exiting Canada? It's, in my humble opinion, they're still going to be in the same position in which they were back in 2009, in which you are a business that has all of its eggs in one basket, meaning you're in one marketplace. And if you actually look in any industry, the top performers of companies who are publicly traded, very, very rarely are the ones that historically over time being able to sustain, operate in one geography. Because you're too influenced by that, right? Remember why they went to international to begin with. They operated in one country and the 2009 financial crisis happened. They were forced to go international, ready or not. Mm-hmm. And so do I feel like they regret the decision? Well, no, because if you look at the stock price, it's, I think, something like tripled. So, so they will say financially, if the role of the CEO is shareholder returns, he's more than exceeded it. Do I believe that there are risks in the business if they continue to operate today? Sure, because you're still in the one thing that you're doing in which you were before, which is you're oversaturated in one marketplace, right? And so do I believe that they're going to go international once again? Yeah. But I think what the Canadian experience is going to massively teach them, and you're seeing this today, by the way, is I think they're going to take it for the learning lessons of what went right and what went wrong. And I think what you're seeing, just again, as a humble Canadian, Target's also changed the way on how they operate. So even in the United States, for example, Target It's one of those companies like, they almost only promote from within, and you get targetized one way. And, the CEO used to be the old push cart, person. And if you look at their management today, you could see that, the current CEO who took over back then in 2014, he was their first ever external appointment hire in the history of the company. So by default, you're already seeing that they're changing, and they're feeling a little bit more like how international companies operate and how they do. If you look on their management team, I encourage everybody to go to their website and go see who their leaders are. Their diversification in experiences are vast more stronger today than they ever been. I have to believe the target experience and the Canadian experience had something to do with that. But if you look at their shareholder returns and their value today, it's at record high. So I do believe they've learned a lot. If you're basing the exit off of financials alone, obviously it was the right decision. Their stock price would suggest it. If you base it solely off of, okay, but then what do you do tomorrow? I think they're already doing it by looking at how they operate. And I do see them going international once again. However, I fundamentally believe it will look and feel extremely different than what the Canada entry did, because you're already seeing it on the way how they're how they're operating their business today in the US alone.
It does definitely seem that that bringing Americans into anywhere, even a place as similar as Canada, is a bad idea. Like when you think of KFC, McDonald's, all these places that local people who are socialized into the system for sure, but local people with local knowledge.
Yeah, and I always say this joke with people. I remember once when I was at Walmart, and they were very good at this. I always use the famous yogurt stories. You walk into a Walmart grocery store today, a Walmart supercenter today, and you look at those 12-pack of yogurts, and they're all going to be, pre-wrapped for us, right? Canadians love their 4 strawberries, 4 chocolates, 4 raspberry. In a lot of markets in the United Kingdom, where Walmart also operates, their consumers don't like when they're pre-shrunk. They like what they call loose leaf. They like to choose the 12 varieties. Some people want all 12 chocolates. Some people want 7 strawberries, 7 raspberry. Walmart, when they entered into the UK through the Asda acquisition, didn't say to the UKers, hey, we're Walmart. In Bentonville, we sell our yogurt as pre-wrapped shrink wrap. They say, hey, we're all about everyday low price. We're all about cost. We're all about efficiencies. We're all about being in stock. But if your localization says that you want the ability to pick and choose what varieties you want because that's the way you shop, it's up to us as an organization to figure out how to execute against that. So you think global, but you have to act local.
Yeah.
Target thought global and thought global meant you act global too, and it doesn't mean that at all.
I guess behind the scenes, it's still logistics and operations, but yeah, that's that on the point of purchase or whatever. I think we should maybe open up to some questions. Does anyone have a question? I think Tabitha has a question.
Yes, I have a question. So as you were talking, I picked out really, I think, 2 qualities that I think are essential that, for someone going into an international market, and they were humility and patience, right? So I think let's assume that if I'm a new company going into an international market and I have both of those qualities, humility and patience, and want to learn about, the target demographic, the target market, the consumers that I'm going to be serving, what do you think is the best way to figure out what that target market actually wants? Because in this case, Target put the executives in charge of operations. Like, you were there, you were one of the Canadian executives, and they still didn't listen. So where's the lesson in that for other companies going forward? Like, how do you learn best about your target market?
Yeah, hey, Tabitha, great question. I think it all starts with do your homework. Target did use, in all fairness, consulting firms, right? I'll leave it at that in terms of what the data suggested from the consulting firms. I think it starts first with so to me, there's 3 parts, two or three parts of this. Number one, if you look at any case study around the world of the best international expansions, you need the best of your best for your home entity product because they know your brand better than anybody else. And then you need, leaders in specific key roles that are experts in that marketplace. So for example, if you're doing a grocery expansion into Canada and you're from another, if you're Tesco in the United Kingdom, sure, bring the best Tesco people over. But then you got to start headhunting the best Canadian retail executives that understand how to blend in the Tesco experience with the Canadian integration. Okay, so that fundamentally has been number two to that. You truly have to be collaborative, that you want to do the balance of the both. A little, in all the target key roles at the most senior level, all but one was a US. And I will tell you, even the people underneath them, even if you're Canadian, giving the feedback, they weren't really open-minded. They would hear you, but they wouldn't listen. So you fundamentally just got to have that humbleness to say, I'm going to deliver this in the properties that makes us who we are, but we're going to do it the Canadian way or whatever marketplace is. And then the second piece in this is, what does your data and insights tell you, right? You got to do your research. You got to do your research. And I see this, and I'm not even using the target example, Tabitha. You don't make decisions. You allow the insights to inform a decision. And far too often, and by the way, this has nothing to do with international expansion. Far too often, sure, there's a little bit of the art and science of your gut. Hey, Steve P is an expert in this space, so he's going to have some just tribal knowledge. Far too often, what I see, and even in corporate strategies, is there's an arrogance of leaders that they want to do what they want to do anyway, despite the fact what the data will tell them. And so they will look at 10 pieces of data. 8 could say go left. But if they want to go right, they will only focus on the 2 pieces of data that say go right, despite the fact that the overwhelming insight says go left. And so just because you're a leader doesn't mean you have to blockade what the data and the insights tell you. And so what I would say in this specific case, there was, without sharing too much specifics, there was enough data and insights provided in terms of what Canadians wanted. I would probably suggest that the data that didn't support what Target wanted to do probably, in retrospect, could have been reviewed a little bit better. However, I see that in the opportunity at all the time. I've, the amount of leaders that I work with that tells, that has data that informs them to go make a call a certain way, and they choose not to listen, is something that has nothing to do with international expansion. It's just, data is supposed to inform an insight or drive into an insight. Your insight's supposed to drive a decision. And if you follow that more times than not, you're going to make a good call. And the joke that I tell everybody is, if you see a business crashing down and there's enough, but my passion is in that industry, if you see that business crashing down and there's enough data that says that the business is going to crash, you're probably not going to invest into that business, right? But if you let your ego, if you let your passion, if you let your stubbornness get a better of you, it doesn't really matter what the data is going to tell you, right? You're still going to do what you wanted to do. Does that help, Tabitha?
Yes, very much. That answers my question. Thank you.
From a broader historical perspective, I kind of think too, there's like having the space to learn doesn't hurt. Like you say, Walmart comes in at a particular moment, it's got huge resources and can go slow. I'm trying to think back. It's been a long time since I looked at it, but when Kmart and Wilco come to Canada, early 60s, they move pretty quickly, but like there's no competition in that chain discount kind of area.
And that's why, Steve, I always say, like, off of day one, the construct of the deal didn't allow for that. Yeah. Like, people always ask me, oh, did they go under because of an out of stock issue? Listen, every company goes through operational challenges. That's the cost of doing business. You could go walk into a Walmart today and they're going to have some kind of executional challenges. You could walk into, a hockey arena and you're going to see operational challenges. That's always factored in, right? There's no organization that operates with 100% efficiency.
Yeah.
However, if you are in such a debt position, you don't have the time to work out the kinks. Mm-hmm. And so it now became a race against the clock, right? You got to generate cash flow because you're so much in debt. If you're in a position of operating in the black, no one ever likes to make mistakes, but you have more time to learn from your mistakes. When you're on the verge of bankruptcy, you don't have that time. Go ahead.
Jason has been very patient with his hand up there.
Thanks, Steve. Nice to see you. You talked about what people expected when they walked into a Target because there's, people can just drive to New York or Michigan or wherever, right over the border and check out a Target location there. And there was a lot of comparing going on, and this appeared in the media as well. So three things you said: people wanted the floors to be clean, to be stocked, and for it to be cheap chic. Number one thing people noticed is that the prices didn't seem that cheap. Number two, the stores seemed messy. And number three, there seemed to be inventory trouble. Like the stores shelves seemed like half as full or less than they did in the US. Was Target aware of this? Were they having inventory trouble getting merchandise on the shelves?
Yeah, so great question. This one is always the one that when I'm at a cocktail party brings up the most dialogue of what actually happened. Okay. So before I share this, I will also share that, prior to Target, I had a lot of different leadership roles at Walmart Canada, including leading their pricing organization. So pricing is one that I could speak really intimately to because I was, I never left when I worked at Walmart a barbecue where I never got someone to ridicule me about Walmart prices. And so let me help display the myths between, what's real and what's fact, what's fiction about pricing between Canada and the United States. Okay. First and foremost, Canada versus the United States. And I can say this for a lot of industries, but I'm just going to use retail for the specific. The cost of operation between the two markets, even when you adjust for currency, the cost of operating in Canada is 30% higher than the United States, right off the bat. Full-fledged, nonstop. So what I tell everybody is no different than when you look at any other industry. You can't assume a $10 shirt, because I used to see those W5 or some of those other episodes too. Advil is $12 in the United States. Why is it 21? Well, before you even adjust for currency, the cost of operations is 30% higher. So why is that, right? And I'm going to give you a couple of examples as to the why. Number one in the US, so number one in Canada, 80% of our population would live within 4 major urban centers. And when you do that, Canada being our large landmass, the cost of real estate is high. In the United States, most retail organizations own their lands because land cost is almost next to nothing. In Canada, even with the big guys, don't look at Loblaws from 60 years ago or 100 years ago. I'm talking about current day economics. Most retailers are tenants in their store. So when you have a Canadian marketplace where you don't own the land and you got to pay lease agreements, and you're in a marketplace where, quite frankly, a very small handful of developers own the vast majority of commercial space, you're comparing, not yourself, Jason, but just in general, you're comparing apples to donuts, not even apples to oranges when you compare the two markets. In the United States, you own your land for the most part, cost of acquisition is really, really cheap, and so on and so forth. You go into Canada, you're a tenant, you're paying absurd leases, so on and so forth. So then you factor in space, and I always share this with individuals. Even down to our building codes, the amount of acreage you need to build a store like a Walmart or a Target is much bigger in Canada, even down to the simplicity of parking spots. And so our building codes force our cost of operations to be higher here. And then you go into the labor side, supplies, materials, and so on and so forth. I love the fact that we have all the protections that we have. That what makes us a great nation. But the consumer ultimately pays. The cost of labor to both build a store and to operate the store on the labor side, even when you adjust for currency. Don't look at the adjustments Walmart and Target had to make because of the competition of scarce labor force. Right before that, if you actually compare the two together, the cost of operation is much, much higher in Canada. And then you look at the products themselves. I spend a lot of times on consumer goods, and I always share this with people, right or wrong, most assembly lines of products are actually, even for Canada, are done in the US. But we also have a marketplace here where we require different things. We require, depending on the category, different formulations. We require a different language to be on their labels. So, plus. All of that drives to higher costs. And at the end of the day, the same things that our marketplace does, but I'm not here to debate around, are we right or wrong for consumer protections? The same, it's kind of like you take from Paul to give to Peter, the same things that we are doing that help protect the population ultimately drives to higher pricing. So what I share with people is, even when you adjust for currency, if a bottle is, $5 more to a headache remedy, well, how would you expect Target or Walmart or any other cross-border retailers to charge the same price if their cost of operation is higher? Their suppliers are charging them a higher price to buy the product because their cost of operating in Canada are higher. Their labor is higher. They don't own their land. They only own leases. So to expect that a Canadian feels that because they saw a $12 shirt in Florida, that shirt should also be $12 in Canada, it's unrealistic. Right. And that was some of the problems in terms of it. And in fact, in certain categories, if people don't realize this, and I won't mention the categories just out of in fairness, a lot of the pricing is actually regulated by the government. And if you look at certain dairy categories, the reason why you see such a price discrepancy, price is not even set by the retailer. It's set by third parties. And so, we used to have some moms that go into Buffalo and say, why does a gallon of milk cost 1/4 of the price in Canada? And my feedback used to be, go talk to your government. It has nothing to do with the retailer. The retailer just gets yelled at all the time. And so that's the pricing answer. Just cost of operations in general is not the same level playing field. In terms of the out of stocks, it goes back to the SAP. Retailers have become more sophisticated like any other business. The challenge with the out of stock is we didn't actually have problems getting in the inventories. The challenge was when you make the call to build a new DC with new staff on a brand new SAP system that has no history. SAP is a great tool, but SAP is also a modeling tool. When you open up, all these stores with no history and no data, it's a predictive tool. It doesn't know. So we did have data issues in the beginning days, right? We're setting up hundreds of thousands of new SKUs with no history. And then in SAP, like most systems, it's trying to plan and predict what your inventories are supposed to be. But you cut off and have no history. So how does it know what to do? So sometimes we would be actually in situations where we flooded the stores. I remember walking in some back rooms where we would have like literally a year of inventory. And then we had other situations where we had no product at all. And so those were the growing pains of what happens when you make the call to say, I want to rip the Band-Aid and I want to start clean. Yes, that's what drove it. One of the factors.
Thanks.
Yeah, that's interesting too to me because, we think of the history of consumer capitalism is partly the history of just logistics and getting products to places. I mean, Eaton's thought about this in the 20s a lot. And as I said earlier, but the extent to which it's like this, you sometimes feel like these are just like storefronts for logistics operations, or surrounded by parking lots. So it's like parking and logistics with a store in between.
Well, and here's
I'm exaggerating a bit, but
yeah. And here's an example. And this, by the way, is very common for most retailers, right? In many retailers, distribute your warehouses to service Western Canada typically is in that Calgary kind of corridor, Alberta corridor area. Now just think about this logistically, right? California is bigger than Canada. California, at the time, I think when I was with Target, we had like 3 DCs, right? California has more stores and 3 DCs just to service, California. Think about that in terms of the cost of moving that product around. Now look at Canada for Target, and at the time, Walmart too, because Walmart's now opened up DCs in Vancouver. Most retailers service Western Canada from Calgary. So that bottle of Advil to be sold on an island in BC is leaving Calgary. Take that same volume and drop it in California. That DC on that truck road ride to go, 100 miles north, and Canadians are expecting to pay the exact same price. Or, for Eastern Canada, most organizations are in that Cornwall corridor to service Quebec and Atlantic Canada. So I always share this with people. A box of cereal, in California only has to travel like 50 miles, 100 miles to get to most locations. In Atlantic Canada, you're actually leaving Cornwall, going down the 401, through Quebec, onto a boat, back off the boat, back onto a truck, sometimes multiple islands, just to get to a store because your DC is in Cornwall. How can we charge the same price? Right? And so Canada, one of the things, and I think this is one of the hard parts in closing on our side, one of the biggest challenges, and Steve, maybe you want to touch on this, is, and this is why you don't see a lot of retailers trying to move into Canada, not because of what went wrong with Target. It's for how big our land, we could do a tab of the whole other show on this, for how big our land mass is, and for how concentrated the 80% of the population is, the efficiencies are just not there. And the cost of doing business in our marketplace is just so much higher that when you actually look at the cost of moving product, and you think, I gotta put something in Calgary just to get it to, an island in BC, it almost puts so many barriers for organizations that the prices that you're gonna have to charge to make any money, you're either gonna be uncompetitive and you're gonna fold anyway, or you're gonna have to be so aggressive, your margins are so thin. Like the Target example, there's not enough margin in there anyway, and you're gonna fold anyway. But if you look at the traditional retailers like a Loblaws, not only do they have a foothold, but there's not a coincidence on why our besides Walmart, some of our most sought after and tenured and successful businesses are businesses and locations in which they have a long history in the marketplace. So they already have sweetheart deals, they already own their own lands, they already got, so on and so forth. But the cost of economics to enter today is just so hard in this marketplace that there's a reason why you don't see the Macy's coming in, or why other organizations like Nordstrom's did a short pit stop and they left too, because the unit economics are just not there.
Well, I see it's actually 3:02, so I think we have to call this to an end. It's been quite fascinating, Steve, to listen to you.
No, thank you, everyone.
First of all, thank you both of you so much for being here today, Steve Penfold and Steve Delios. That does, you're right, take us to the end of our time today. So some really important lessons in this CBH talk for retail leaders or anyone considering international expansion with their retail or other kinds of businesses. So thank you to both of you for being here today. Thank you for all of our Canadian Business History Association members who are on the call. And thank you to everyone who's watching the replay of this video on YouTube, wherever you might find yourself in space and time. On behalf of the Canadian Business History Association, I'm Tabitha Fritz, and thank you all so much for watching.